Silver just did something that should permanently change how you think about every market you'll ever touch, not because of the price move, because of what the price move revealed about the machine underneath. Silver ran to 121, the CME raised margins, silver crashed into the 70s, and then, the detail that detonated across every finance forum on the internet, the interpretation drawn from widely watched positioning data and exchange chatter that JP Morgan may have covered shorts right at the bottom. At the exact moment retail panic was at its most violent, at the exact moment your phone was lighting up with red candles and your group chat went completely silent. Now here's where I'm going to do something different. I'm not going to give you heroes and villains. I'm not going to hand you a conspiracy and call it analysis, because that framing, while emotionally satisfying, makes you weaker every time you use it. It trains you to look for a culprit instead of a pattern, and patterns are what save you. What I'm going to give you is a mechanism, 4 stages, a skeleton key that works on silver, gold, oil, crypto, and stocks. Any leveraged market, any decade, any headline. By the time this is over, you'll be able to look at a chart and identify which stage is active. You'll know what to watch for before the trapdoor opens. And you'll understand exactly how to stop being the liquidity that the strongest players harvest when it does. But first, one number, because this number is the reason these events are getting bigger, faster, and more frequent. Global debt hit a record of approximately $348 trillion in 2025. It rose by nearly $29 trillion in a single year. Sit with that, because debt is leverage in slow motion, and leverage does one thing to a system over time. It makes it fragile. Fragile systems don't fail quietly. They fail through violent periodic stress tests. And stress tests, in markets, look exactly like what you just watched. A sudden flush that strips positions from weak hands and transfers them at the worst possible prices to strong ones. So if you want a simple silver is bullish take, this isn't it. This is about the engine running behind every big move. Because once you can see the engine, you stop reacting to headlines. You start reading the road ahead. Here's the pattern. 4 stages. You're going to hear them more than once, because this is the kind of framework that only sticks when it's been repeated enough to feel automatic. Stage 1 is the setup. A narrative becomes dominant. Leverage becomes normalized. The market fills with people who don't own the asset. They rent exposure to it through borrowed money and derivatives. That distinction matters more than almost anything else I'll say today. Stage 2 is expansion. Price rises, confidence rises, position sizes rise. The late money that comes in is always the most fragile money. The crowd is largest right before the cliff. Stage 3 is crisis. Something spikes, something breaks, and the gatekeepers, exchanges, clearinghouses, brokers, tighten the rules. What happens next is not a choice. Overextended traders don't decide to sell. They are forced to sell. That word, forced, is the entire ball game. Stage 4 is transfer. After forced selling exhausts itself, the strongest hands absorb what the weakest hands dumped. The narrative resets. The cycle begins again, quietly, while the people who just lost are still too angry to pay attention. If that sounds too clean for a world that feels this chaotic, that reaction is actually the point. Clean mechanisms are exactly what produce the messy outcomes you see. The surface is chaos. The structure underneath is almost boring in how predictably it repeats. Let me prove that with history. Not to tell old stories, but to show you this machine has already run on human beings, across different decades and different assets, and the output never changes. The crash that defined a generation. It wasn't primarily about fear or fraud or some singular panic. At its mechanical core, it was about margin calls. The 1920s built a cultural religion around stocks. Newspapers celebrated market millionaires. Buying on margin, borrowing to amplify gains, became socially normal. It stopped being thought of as risk. It was treated as participation. That's stage 1. The setup is complete when the risk disappears into the background noise of optimism. Then expansion. Rising prices made collateral look sufficient. Rising prices made lenders feel safe. Rising prices made risk feel like a myth. That's the cruelest trick of an expansion phase. The more fragile the system becomes, the more stable it appears. The rot hides beneath the returns. Then crisis. Prices wobble. Drop faster. The margin loan that felt like a tool becomes a noose. Brokers demand more cash. Most people can't produce it. They're forced to liquidate, not because their thesis was wrong, but because the structure of their position gave them no choice. And as they sell, prices fall further, triggering more margin calls, forcing more selling. A feedback loop, mechanical, not emotional. That loop turns a decline into a catastrophe. Transfer. Those with cash and patience buy what the leveraged public had to abandon. The crash wasn't a storm. It was leverage meeting liquidation, on schedule, just like it always does. Now the late 1970s into 1980. Silver. A moment so relevant to today it almost feels like a rehearsal. The setup was a collapse in currency confidence. The Nixon shock had severed the dollar from gold. Inflation surged. People were waking up to a truth that felt new then and feels even more urgent now. Money can be expanded politically, indefinitely, and the cost lands on the people holding it. Precious metals became a form of protection. Silver in particular drew attention because it was cheaper than gold, had real industrial demand, and could be leveraged through futures contracts. Expansion followed. Big positions accumulated. Futures allowed massive exposure for a fraction of the actual value. As prices climbed, more participants piled in. The trade became crowded, identity-driven, emotional. Silver is going to the moon stopped being a prediction and became a personality. Then crisis, triggered through exchange rule changes and margin adjustments. Whatever the motive, the mechanism is indifferent to motive. Raise the cost of holding a leveraged position and you force selling. If you must post more cash to hold the same contracts and you don't have the cash, you reduce exposure, you sell into a falling market, and everyone doing that simultaneously turns a correction into a rout. Transfer. Late entrants destroyed. Control returns to those who could survive the chaos. The public learned silver is dangerous. The system learned something more useful. Margin is a lever. Jump to 2011. The setup this time was built on the wreckage of 2008. Trust in banks had fractured. Quantitative easing was reshaping how people understood money. Money printing became household language. Precious metals became a magnet for anyone seeking a hedge outside the banking system, which at that moment felt like almost everyone. Expansion. Silver rallied hard. Retail participation exploded. Leverage multiplied. The later you entered, the less margin you had for error and the less capacity you had to withstand a reversal. Crisis. Margin requirements were raised multiple times in rapid succession. Not once, repeatedly, over a short window. That is not a minor technical adjustment. That is a system-wide demand for immediate cash across thousands of traders at the exact moment prices are already moving against them. The cascade that followed was not caused by a change in silver's fundamentals. It was caused by a change in the cost of holding the position. Transfer. The flush completed. Patient capital accumulated. Emotional capital fled and swore it would never return. Until next time. Different decades, different headlines, same 4 stages, same machine. Now apply it to what you just lived through, cold and clinical. Before silver hit 121, the setup was already complete, a world running on record debt, a financial culture trained to chase returns through leveraged exposure rather than patient ownership, a derivatives market where price is often discovered in paper contracts, not in physical delivery, and a participation base that depends on leverage because wages and savings don't feel sufficient anymore. That is a foundation built for a liquidation event. The only variable was timing. Expansion. Silver rallies, headlines follow, and leverage follows faster than either. Open interest grows. Options activity multiplies. The psychological temperature rises. And here's the part nobody says out loud. The higher price climbs, the more dangerous the position becomes for anyone on the wrong side, because notional exposure balloons. And when notional exposure balloons, the people responsible for keeping the plumbing intact start watching very carefully. Their concern isn't whether silver is fairly valued. Their concern is default risk. If a violent reversal causes enough participants to fail on their obligations, the infrastructure itself is threatened, so the system prepares to protect itself, usually at your expense. Crisis, the margin shock. This is where the event stops being about silver demand and becomes about math. When the CME raises margin requirements, your thesis becomes irrelevant. You can be completely correct about silver's long-term value. It doesn't matter. If you're leveraged and you can't meet the new cash requirement, you are a forced seller. Full stop. Let me make that concrete because most people hear margin hike as a headline rather than as a guillotine. A Comex silver futures contract represents 5,000 ounces. At $100 per ounce, that's $500,000 of notional exposure. But you're not posting $500,000. You're posting a fraction, perhaps something in the range of $22,000. The exchange raises that requirement to roughly $25,000. That's a $3,000 demand that lands immediately across thousands of accounts while price is already in freefall. Many traders can't meet it, so they sell, or they get liquidated automatically. And all those sell orders arrive in the market at the same moment. That's why the flush doesn't feel like a staircase. It feels like a trap door. And the bottom of these events has a signature you need to memorize. Your screen looks broken. Your thesis feels embarrassing. The group chat is silent or full of rage. People are declaring the market dead and swearing they'll never come back. That's capitulation. That's the system completing its transfer, extracting positions and confidence from the maximum number of participants at the worst possible prices for them. When someone tells you margins were raised to protect the clearinghouse, they may be telling the truth. But there's a sentence they almost never say next. Protecting the clearinghouse transfers the stress onto whoever cannot meet the new terms. The system survives. You pay the cost. That is not a bug. That is how the design functions. Now let me destroy 3 beliefs that feel protective but actually make you more vulnerable. The first, if I'm right on fundamentals, the market will eventually reward me. Fundamentals govern outcomes over time. In a liquidation event, they are temporarily irrelevant. You can be right and still be erased, not because the market disagreed with you, but because your structure made you a forced seller before your thesis could play out. The second, a stop loss keeps me safe. In slow, orderly markets, stops help. In cascades, clustered stops become accelerant. They trigger simultaneously and execute into the thinnest possible liquidity. A stop loss in a liquidation event can turn a manageable loss into a catastrophic one. The third, I'll just trade smaller next time. Smaller only helps if smaller means you can genuinely withstand the full magnitude of what the machine is capable of producing. In a forced liquidation event, price can overshoot so far beyond any rational level that smaller still isn't enough if you're leveraged. Now connect this to the macro environment you're actually living in. In a world sitting on record debt, institutions and policymakers become acutely sensitive to volatility. The system develops reflexes. Tighten here, stabilize there, sacrifice whoever is most overextended, keep the core functioning. Margin hikes are the micro-level version of that reflex. And here is the implication you should not look away from. The more leveraged and fragile the system becomes, the more frequently you will see liquidation events across every market, not because of any single villain, but because the structure is designed to survive by charging its cost to whoever is most exposed in that moment. The goal, then, is not to beat the system in some fantasy sense. The goal is to stop being the cost it charges. Stage 4. Transfer. This is the part people feel in their gut but can't quite name. After forced selling exhausts itself, the strongest hands accumulate what the weakest hands had to abandon. The asset doesn't become cheap because the world suddenly stopped believing in it. It becomes cheap because people who had no choice sold it into maximum fear. And this is where the J.P. Morgan narrative, whether you treat it as confirmed fact, reasonable inference, or symbolic story, carries its real lesson. Because in every forced liquidation event, the critical question is never who is smartest. It's who is least forced. The least forced participant can wait, can scale in while everyone else must scale out. If they're short, they can cover into the fear at the bottom, because fear creates the kind of liquidity that is normally unavailable. The outcomes that look supernatural in hindsight don't require perfect coordination. They only require asymmetry, one group acting under compulsion, another group acting freely. Now hear this clearly, because this is bigger than silver. We are moving into an era where forced liquidation events will occur more often, across more markets, with greater speed and severity. Debt is higher than it has ever been. Trading infrastructure is faster than it has ever been. Retail participation is larger than it has ever been. And a decade of central bank intervention has built a culture of risk-taking that is systematically disconnected from consequence. That culture is going to be tested repeatedly in the years ahead. But instead of leaving you with that as a warning and nothing else, here's what you actually do with it. First, know whether your market is price discovered in a leverage arena. Futures, options, leveraged ETFs, perpetual swaps. These are environments where forced liquidation can happen at scale and without warning. Margin is not a footnote in these markets. It is a weapon that can be turned against you. Second, watch for overcrowding. You don't need proprietary data to see it. Overcrowding shows up as euphoric narratives, one-sided commentary, and the particular feeling that a trade is completely obvious. The moment a move feels obvious to everyone is often the exact moment fragility is at its highest. Third, watch the gatekeepers. Exchanges and clearinghouses don't care whether your analysis is correct. They care about volatility and default risk. When volatility rises, margin requirements follow. When margin requirements follow, the most overextended participants get targeted. Track volatility regimes. Pay attention to margin announcements. These are not footnotes. They are the early warning system. Fourth, stop assuming the flush will stop where your emotions can handle it. These events are specifically designed, structurally, mechanically, to push price far enough to generate maximum capitulation. The low will feel wrong. It will feel irrational. It will make you question your entire framework. That's not accidental. That is the function. The low has to feel impossible to do its job. And if you hold silver on leverage, or any asset on leverage, accept this single sentence and let it change your behavior. You can be completely right and still be forced out at the bottom. That is not a personal failure. That is a design feature of the market you chose to participate in. So what do you actually do? You separate conviction from structure. If you believe in silver over the long term, build your exposure so that no one can force you to sell it. That means less leverage, longer time horizons, entries spread across multiple points, and liquidity held in reserve, not as wasted potential, but as the one thing that transforms a crash from a catastrophe into an opportunity. Cash is not dead money in a leveraged world. Cash is optionality at the exact moment everyone else has none. If you trade leveraged silver short term, trade the plumbing, not the narrative. Track margin conditions, volatility regimes, positioning signals, and where forced selling could cluster. That is where the real price action originates. Now the final piece. What happens after a transfer event completes? Two things, reliably. The narrative shifts. The asset gets declared dead. Media moves on. People feel shame and swear off the market. That is one thing. The second thing happens quietly, beneath the noise. Volatility gradually falls. Margins eventually normalize. Strong hands accumulate at prices the public will later call obvious bargains. And when conditions align, when the setup for the next cycle is ready, the asset moves again, with a stronger ownership base, with less fragile hands holding it. Traveling further than anyone who sold at the bottom can emotionally accept. That's why bottoms feel like betrayal, because they are engineered to remove people who are emotionally committed but structurally fragile. The bottom doesn't feel like an opportunity. It feels like confirmation that you were wrong. That feeling is the machine's most powerful tool. The silver move from 121 to the 70s was not a silver story. It was a system story. Setup, expansion, crisis, transfer, running exactly on schedule, exactly as it has run in every leveraged market across the past century. The debt is higher now. The technology is faster. The participation is broader, which means the cycles will be more intense, more compressed, and more frequent. The question you have to answer, not theoretically, but in how you actually structure your money, is simple. Are you the person who can wait, or are you the person who must sell? One of those people gets transferred to. The other gets transferred from. Be the person who can wait. Keep liquidity. Reduce forced exposure. Learn the plumbing. And when you see stage 3 forming, when volatility is spiking and collateral rules are tightening, understand that a transfer window is opening. The market is about to try, with everything it has, to make you do the one thing that guarantees you lose. Name the stage, know the machine, and stop being its fuel.